Very good morning, friends. So I hope you're all doing well. Enjoyed your weekend. Nice weather back in Delhi again. I think it's a little different. Monsoons, I think, have already come in. So I hope you've also been able to make a cumulative revision of the consolidated standards as well. You've done your own consolidation as well. So to remind you, we were discussing the last phase of Index 110, and we'll be starting with Index 111 also today. But there is one last inputs left in 110, and that is regarding the changes in the ownership interest. Though I give you a very quick brief on the concept of what do you mean by a changes in ownership, but we're going to discuss that in detail right now. And after that, we're going to take it forward and we're going to do Index 111 on joint arrangements. Okay. Now, I think first, let me give you a chain of thought that when we are looking at a changes in ownership interest, then what kind of permutations and combinations are we looking at? Broadly, we can say there could be two kinds of cases. One is we can say that there is no loss of control. That means in spite of a change in the percentage, mind the words carefully, I'm saying in spite of a change in a percentage. Now, when I say change in percentage, it could be increase or a decrease in a percentage. And if you say that there is no loss of control, or we can say there could be a loss of control. So let's do one thing. Let's give you a chain of thought on the basis of which we're going to work upon. So we're looking at the section changes in ownership interest. So we're looking at the changes in the ownership interest. So broadly, when we're looking at the changes in the ownership interest, we can segregate this in two parts. So we can say in terms of changes in the ownership interest, there will be broadly two kind of cases. One is there is no loss of control. So one is a situation, there is no loss of control. So there is an increase or a decrease in a percentage and still the control continues. So this is a case where we can say that in spite of the percentage increase or decrease, the control continues. So this is one broad case which can happen. And the second one is that there is a loss of control. So when we say there is a loss of control, it indicates that the relationship is undergone a change. The control is no longer there. So we can say the relationship changes. So either the relationship is totally gone or the relationship changes from a control to a significant influence or from a control to a passive investment, whatever. Okay, so now let's look at some permutation combinations which could happen in each of these broad cases. So when I'm looking in terms of no loss of control, I would say there will be broadly again two kinds of situations. So this is like case number one. And I would say this is like case number two. And if we were to divide these cases in terms of situations, we could say there could be a case of disposal. And that is, of course, a case of, you can say, a partial disposal, but the control continues. Or it could be a case of further acquisition. And when it is a further acquisition, improvement in the percentage. So I would say this is like situation number one. And this is like situation number two. So just to give you the inputs in terms of how the percentages would move. So let's say I'm just taking an arbitrary example. We had a 90% stake and we come to a 80% stake. So we had a control, we still have a control. So even though there is a disposal, the percentage is such that the control continues. So we need to see what happens in this particular case to the goodwill or to the NCI and to the consolidation done. And if it is a case of further acquisition, it could be the other way around. You had an 80% stake and it improves to 90%. So the control was there earlier as well, and the control is there now as well. So these are the two typical situations which could arise in terms of no loss of control. So the percentage undergoes a change, but the control was there earlier. The control still continues. So Ind AS 110 continues to apply. That is the focus point. Okay. Now, one clarification which I like to put it right away at this particular stage. If it happens a situation 1 or 2, goodwill will not undergo a change. So let's keep one broad principle in mind, that if a company makes a further acquisition or if a company makes a disposal and the control continues, we are not going to make any changes to goodwill. Ind AS 110 recognizes the fact that when there is a change in a percentage and no loss of control takes place, it is like, equity shareholders dealing with each other. So basically, the majority is dealing with the minority. You can say the controlling interest is dealing with the non-controlling interest. So it's a transaction between the equity owners. So if it is a transaction between the equity owners, we just need to pass a very basic entry recording the transaction between the equity owners. Let's put that once again. So you need to keep some broad principles in mind, that in a situation where there is no loss of control, either due to further acquisition or due to a disposal, goodwill is not going to undergo a change. So one principle which we need to keep in mind is that goodwill will not change. So we're not going to change the goodwill which was computed earlier because of this change in the percentage. It is supposed to be treated as transaction. It is supposed to be treated as transaction between, you can say, the owners and NCI. Owners are the people who've got a controlling interest, and the other set of people is the non-controlling interest. So we're going to treat this as a pure transaction between the owners and NCI. I'll give you the accounting treatment very shortly. Let's go to the case number 2 first. Now, in terms of the case number 2, when we're looking at that there is a loss of control, a couple of situations could arise. So broadly, I would say there will be 2 situations again. So we can say broadly, there will be 2 situations. So let's segregate this in 2 situations. One is that it is a full disposal. So one is that it is a full disposal, or I would say there will be a partial disposal to get the chain very clear. So there will be either a full disposal or there will be a partial disposal. Now, when I say a full disposal, just to give you the percentage, let's say we had an 80% stake, we sold the entire stake, and in this particular case, the percentage became nil. That is a case of full disposal, 100% disposal. But when we come to a case of a partial disposal, there could be some more permutation combinations which could take place in this case. So we can say in terms of a partial disposal, I can think of at least 3 situations. Number one is a case where from a control, you move to a case of a significant influence. That means you move away from Ind AS 110 and you move towards Ind AS 28, because the significant influence would mean that you are now under equity method of accounting, though we yet to discuss Ind AS 28. But then control to a significant influence could be the case, or it could be a case of control to a passive investor. So when I say that you're moving from a control to a passive investor, it is like moving from Ind AS 110 to Ind AS 109. A passive investment would be that you've got a stake which is below 20%, and therefore it becomes an ordinary investment, and you move to Ind AS 109. So I would say this is moving from Ind AS 110 to Ind AS 28. This is moving from Ind AS 110 to Ind AS 109. And interestingly, there can also be a very interesting case which is given in the study material as well. And that is a case of what we call a deemed disposal. So I'm not saying that what it would result in, it may result in any of the 2 situations. A deemed disposal would mean control to significant influence or a control to a passive investment. So this is called a deemed disposal, where you don't actually make a sale of shares, where you don't actually dispose of any shares as an investor, but somebody else does a transaction, and due to which your percentage comes down. So these cases are that you actually make a disposal and the percentage changes. But a deemed disposal is a very interesting situation where, some other investor takes a transaction, and due to his transaction, maybe he exercises an option contract which he is entered into, and this dilutes your percentage and your status could undergo a change. Okay, so which means that I am looking at how many situations in this case. I would say full disposal is situation 1, a partial disposal, control to significant influence, situation 2, a control to a passive investor, situation 3, and a deemed disposal is going to be a situation 4. Wow. So we've got 2 situations plus another 4, a total of 6 situations, which is going to take care of the concept of changes in the ownership interest. So I think, let me just quickly give you the mind map, the thought process, which we are going to work upon as far as this particular section is concerned. So I hope you've been able to catch up with the thought process which I've given you. But let me just, I think, quickly give you the thought process once again on this. Okay, so let's consolidate the picture so far and let's take the journey. Okay, that's great. Good morning once again to all of you friends. Okay, so now let's, I think, take it further and let's consolidate the picture in terms of the last section on Index 110. So we are looking at the concept that there are changes in the ownership interest. The percentage undergoes a change. So broadly, the percentage changes is segregated into 2 areas. One is that if the percentage undergoes a change, the control is not lost. You are still under Index 110 itself. So which means that there could be a disposal or there could be a further acquisition, and that means the control still continues even though the percentage comes down or the percentage goes up. But what you need to remember is the 2 basic principles, that if the control is not lost, you don't need to change the goodwill which was computed earlier. We cannot say that goodwill computed was supposed to be based on a 90%, and now if the percentage has come to 80, we don't need to change any goodwill. It is just a transaction between the owners and the NCI. So we're going to see the accounting treatment. How do we handle this? The second broad case is that there is a loss of control, and due to which either it could be a complete disposal, bringing your percentage to 0, or it could be a partial disposal, changing the relationship from a control to a significant influence, moving to 28, or it could be a control to a passive investor, moving to Index 109, or there could be a deemed disposal where I don't consciously sell anything, but some other investor takes an action and my percentage gets diluted. Okay, now let's do one thing. Let's make your life simple. I made this entire chart to you, but I'm going to look at the accounting treatment for the 2 broader cases. I'll give you 1 entry for this case, and I'll give you 1 entry for this case. Though in the first one, I need to give you 2 entry because this could be a further acquisition or disposal, but this is completely a disposal. So let's now look at the accounting treatment. Then we'll look at some questions with you. So let me create another chart which will now outline the accounting treatment. So what is the accounting treatment which needs to be done in the 2 broader cases which we've identified? So let me divide this in 2 sections. So I am looking at that there is no loss of control. And in this case, there are 2 broad cases. A case of disposal or further acquisition, and this I'm covering all the cases. Now watch me carefully. This is a technique which is going to help you easily calculate the transaction, the accounting for the transaction. Okay, now let me tell you, this accounting treatment is applicable. This accounting treatment is applicable to consolidated financial statements. I'm not talking of the accounting treatment in a separate financial statements. If you were to do an accounting entry in a separate financial statements, the normal accounting will be done. If you make a sale, it's bank to investment. And if you're going to make a purchase, it is investment to bank. So we're not looking at the accounting treatment from a separate financial statements point of view. These entries which I'm giving you is purely from the point of view of the consolidated books of accounts. Okay. So we've got a case when there is no loss of control. So we've got a case when there is no loss of control. And let's consider there is a disposal. And let's consider that there is a further acquisition. And we're looking at a situation where there is loss of control. And I am looking at all the permutation combinations in this case. So all the permutation combinations which I gave you. Okay. Now watch this carefully. If you say that there is no loss of control and it was a case of disposal of shares, and it is a case of disposal of shares, you are going to put the entry bank gets a debit, which is to the extent of the sale proceeds. And imagine if you had a 90% stake and you have now got an 80% stake. The NCI earlier was 10%. The NCI now is 20%. So you need to basically increase the NCI in the books of accounts by 10%. Simple and straight. So which means that if it is a case of a disposal, you need to put the entry bank with the sale proceeds and the NCI increases by another 10%. Instead of 10, it has become 20. So you need to make a proportionate change in terms of NCI, and naturally there will be a difference in this entry. The balancing figure in this entry is going to be directly taken in equity, that is in the statement of changes in equity, SOKI, because this is a transaction with the owners. Now you would also remind yourself that in terms of Ind AS, when there are any transactions between the company and the owners, or between the company, between the owners, we never take a hit on the profit and loss account. Like, for example, if you pay a dividend to the owners of the company, that dividend is directly reduced from the retained earnings in SOKI. So considering that in this particular case, the transaction is not with outsiders, but the transaction is only with the shareholders. So any kind of gain or loss which arises on account of this transaction is not going to hit the profit and loss account, but we're going to take that gain or loss, whatever the case might be, directly in terms of equity. As simple and straight. Okay, now coming to the other case, if it is a case of further acquisition, let's say from an 80%, you come to a 90%. So you can see that in this case, NCI was 20% and now the NCI reduces. So you just need to reverse this entry. So what I'm going to do, NCI will be given a debit. You need to decrease the NCI by 10%. A proportionate reduction would take place. And since it is a further acquisition, the bank gets a credit to the extent of the purchase price we paid. So whatever is the purchase price we paid, and whatever is the balancing figure in this entry, the gain or loss, is going to be taken again in equity directly. That means we're going to put this in SOKI directly itself. So the treatment is very simple and absolutely straight, which means that if there is no loss of control, you just need to put the entry bank NCI. If the control is going to dilute, you need to increase NCI. And if the control enhances, you need to decrease an NCI. So the entry would either be bank to NCI or NCI to bank. And any difference in the entry, the gain or loss, is considered directly in terms of equity. This is one broader case. Now let's have a look at the other situation where there is a loss of control, and I'm looking at all combinations, whether it is a complete disposal or whether it is a case of a partial disposal with any kind of permutation combinations. Now, hear me carefully. When you acquired a control, what did you do? You did the acquisition entry under Ind AS 103. And now if you're going to lose a control, what are you supposed to logically do? Reverse that entry. So I think the easiest way in terms of doing the calculations is that you put a reverse entry of Ind AS 103. So whatever entry you did at the time of acquisition accounting, just reverse that entry. So I'm going to give you the entry. Let's watch this out. So in this particular case, now just keep the entry of 103 acquisition accounting, and whatever you did debit, credit, whatever you credit, debit. So in this particular case, liabilities will be given a debit and the assets are going to be given a credit. So what I've done, I have de-recognized the liability because the control is lost. So I've de-recognized the net assets which were a part of your consolidation. The NCI at that stage was given a credit. Now you give a NCI a debit. Your goodwill was given a debit at that stage, so we're going to give a credit to the goodwill. So de-recognition of the NCI, de-recognition of the goodwill. At that stage, the purchase consideration was paid, so bank was given a credit. Now you're going to get money, so bank is going to be given a debit in this case. And there is also a possibility that you might have retained certain investment. So if you've retained certain investment, then whatever investment is retained, we can give a debit to that portion as well. Now let's get some finer tuning done. So in this particular case, you can see what I'm doing. I am exactly doing a reverse entry. If you notice, I am doing a reverse entry what I did in terms of acquisition accounting. It's a reverse entry of Ind AS 103 acquisition accounting, and that's going to make life simple. Now, let's look at also some intricate details on the amounts which are going to come in this particular entry. So when I say investment retained, this investment retained will be at the fair value. So let's say, for example, you're converting from, let's say, a control to significant influence or a control to a passive investment. So whatever investment is retained, you're going to record that in the fair value. So watch out in the question for any details on the fair value. As far as the assets and liabilities are concerned, they are going to be de-recognized, you can say, at the book values which are appearing on the date of disposal, because you need to de-recognize it at the values which are appearing at the date of disposal. So that would also be very clearly stated in the question, that what is the book values of these assets and liability which needs to be de-recognized at the date of disposal. The NCI would, of course, again be, you can say, the value on the date of disposal itself. So we need the NCI also on the date of disposal. So bank is going to be debited with the sale proceeds, if any. I'm putting the word sale proceeds, if any. Because if it is a case of a deemed disposal, you may not receive any money. Because if it is a deemed disposal, we never made an actual sale. And if there is no actual sale, I've given that bank gets a debit to the extent of any amount received, if any. And goodwill, of course, will also be the value which is there on the date of disposal. So watch out for the information in the question. So the focus point is that you need to basically put a reversal entry of 103. De-recognize the assets and liability, de-recognize the NCI and the goodwill, record the bank, and record the investment retained, if any. So this also, I'll put it as investment retained, if any, because if it is a complete disposal, the investment doesn't get a debit. But just like the earlier cases, this entry may not tally. So there would be a difference in this entry. Now, this is a proper gain or loss on disposal. So any balancing figure which we are going to get in this entry is going to be a gain or loss on disposal, and that is going to be taken in the profit and loss and not equity. So in this particular case, any gain or loss is getting entered in the equity because it's a transaction between the owners and the NCI. But in this particular case, the relationship comes to an end. So this is going to be considered as a gain or loss, and this is going to be taken in the profit and loss account. So conceptually, I have given you the inputs on the accounting entries with reference to the changes in ownership. So you just need to broadly remember two main entries. One is the entry if there is no loss of control, bank NCI gets impacted. And what is the case where there is a loss of control, a reversal entry of 103. I think let's do some questions with you so that we can get some good idea on these permutation combinations. So let me see if any questions coming at your mind, and otherwise we take it forward. Okay, so I think, John, you've got a question. Change from a significant influence to a passive investor, well, that would be covered in terms of Ind AS 28. Now, I think you raised a very valid question. I'll just give you some thoughts. And I think you said, so in case of NCI, the fair value of the asset will be taken as on the date of acquisition or the date of settling for 10%. Well, I'll just take practical illustrations with you where I'm going to give you an insight in terms of which figures are exactly taken. But let me first come back to your first question, which you asked. Now, this is very interesting indeed. You know, if you technically ask me, and I want to get my concepts very clear, though I will not be able to do that exercise, we've got a certain time frame within which we need to do things as well. And I think, you know, since Ind AS is huge, like, I would say so huge indeed, that it's very difficult to cover up so many things because you can get into depths and depths. There is no dearth of learning. But let's give you a chain of thought on the basis of which you could do your possible research. Now, I would say broadly, there could be a case of a step acquisitions. So there could be a case of step acquisitions, or there could be a case of disposal. This is just a basic chain of thought which I'm giving you, and you need to be, technically very clear of all the kinds of movements which can take place. So the chain is something like this. You were standing at a zero and you became a passive investor. When I say passive investor, it is supposed to be below 20%. So this is moving from a zero level to a passive investor, or it could be again a further acquisition. And let's say you get a significant influence, which is supposed to be 20% or more than 20% holding. Or then it could also be a case where you move on to a control, and that is generally supposed to be a 50% plus. This is 20% or more, but you can say, but up to 50%. So that becomes a significant influence. And if it is 50% plus, it's a control. Now, there could be a lot of direct jumps as well. So you can see this is not a step acquisition, undoubtedly. If you're moving from a zero to passive investor, this is undoubtedly not a step acquisition. So even if you move directly out here, it is not a step acquisition. Even if you move directly out here, it's not a step acquisition. So what is a step acquisition? If you're moving from a passive to a significant influence, it is a step acquisition. If you're moving from a significant influence to control, it is again supposed to be a step acquisition. Or even if you move like this, it is again a case of you can say step acquisition. So there are possibly, you can say, three combinations one needs to be clear on, that if you convert from a passive to a control, this we've already covered in Ind AS 103. If you remember, we've already covered this in terms of Ind AS 103. Now, if you move from a passive to significant, okay, even significant to control, this also we've already covered in Ind AS 103. So we've already covered these two cases in terms of Ind AS 103, and this is a case which ideally would get covered under Ind AS 28, but many cases are not there directly in the study mat. But if you look at the education material on Ind AS 28, it covers all the permutation combinations and different standards. So what I'm trying to give you is that this is a case which gets covered in 28. This we have covered in 103, and this we have covered in 103. Then there are other special kind of cases as well, which I'm giving you for your research levels. Can I say it is also possible that the significant influence increases? That is also step acquisition. or the control percentage increases, that is also a step acquisition. That means you've got a significant influence, the percentage improves, but you're still significant influence. Now, this is again, which has been very appropriately covered under Ind AS 28 educational material as well. And this is a case when the control increases. This is what we are covering under Ind AS 110. So different cases have been covered at different places altogether. So you can now see that there are a lot of combinations coming in: 1, 2, 3, 4, 5. So a total of 5 combinations. And out of which, 3 combinations are very direct. So it could be 5 possible permutation combinations of step acquisition. Technically, you should be very clear in terms of how the accounting treatment of all these cases takes place, because the main issue is the treatment of the amount which is accumulated in the OCI. Oh my God. Remember when I did the case of conversion of significant influence to control, I gave you a detailed analysis of how the scrutiny of that OCI is done and what amount enters in the RE and what amount enters in terms of the, you can say, profit and loss. This is one part of the discussion. Now let's have a look at another part of the discussion. If it is a case of disposal. So that means you are under a control, and let's say from a control, you convert to significant influence, or you convert to a passive investment, or in this particular case, you go on to a 0. So it's the other way around. The chain is the other way around. So when you're looking in terms of a disposal, I would say that if it is a control to significant influence, it is a disposal. Significant to passive is a disposal. Passive to 0 is a disposal. And the chain could be something like this. The chain could also be something like this. The chain could also be something like this. Even this is a disposal. Even this is a disposal. Even this is a disposal. Can you look at the chain of thoughts on the various combinations of disposal? Now, let me also take it a bit further. So when you look at a case of control to 0, we're going to cover this now in Ind AS 110. When you look at a control to a passive investor, we're going to look at this in Ind AS 110. So when you're going to look at a control to significant influence, we're going to look at in Ind AS 110. So these cases are getting covered out here. You're converting to 0, a passive, or this. Now, when it is a significant influence to 0, you're going to cover this in terms of Ind AS 28. Education material discusses that. A significant influence to a passive investor also covered in terms of Ind AS 28. And in terms of passive to 0, this is something which you've already covered in Financial Instruments 109. Wow. Which means 1, 2, 3, 4, 5, 6 cases. So I would say a total of 6 cases out here, a total of 5 cases out here, but makes it a total of 11 cases. You know what you need to do for your own clarities of thought. Since you'll be covering certain cases in 103, certain cases in 28, certain cases in 110, and certain cases 109, you create a chapter of your own. Call it as a step acquisitions and disposals, and gather all the questions together. I would have done that part and created a separate chapter. I wanted to study things. I, of course, have done that. But I think if I make all these 11 cases, and I think we spend almost like, 6-7 minutes on each case as well. Oh my God, 11 cases into around 6-7 minutes is almost around what? Maybe the more than that. I think if you take around 10 minutes a case and we've got 11 cases, almost like converts into one complete class. But trust me, if you want to get a clarity of thought, I've given you a thought process of how the step acquisitions and disposals are there, because you might have covered these things bits and parts. So far, I have been able to cover only 2 cases with you, but a lot of cases, as you can see, we're going to cover now in terms of Ind AS 110. I guess that would have given you a chain of thought. Okay, so let's take it further. I think with that particular chain of thought, I'm now going to take it further, and let's now do some questions with you on that area. So that was just for research point of view. Okay. So I think with this particular accounting entries in hand, let's take you to a practical illustration. And let me take you back on the assignment and let's have a look at a few selected questions with you. So this is, first of all, a case where there is no loss of control. I think let's take you to a question number 9. I think the visibility should be good enough. So let's have a look at the question number 9. It's a question which is there in the education material. So I want to have a look in terms of how we are going to solve this particular question. Okay, so let me begin the journey and let me first read the question to you. And let's have a look at this particular case. Let me just open up the question also in front of me so that at least we do anything incorrect on that ground. Okay, so let's begin. It's a pretty simple question indeed. It says entity A sells a 30% interest in a wholly owned subsidiary. So 30% interest in a wholly owned subsidiary, that means you are converting from 100% to a 70%, which means that there is no loss of control. It's a case of a disposal where there is no loss of control. That is pretty clear. The moment you look at this case, the question comes to the mind, bank to NCI, NCI to bank case, no loss of control. Then he says it is sold to outside investors in an arm's length transaction for 500 crores in cash, and it retains a 70% controlling interest in the subsidiary. At the time of sale, the carrying value of the subsidiary's net assets in the consolidated financials is 1300 crores. Additionally, there is a goodwill of 200 crores that arose on the subsidiary's acquisition. He gives you the position of the net assets. He gives you the position of the goodwill. But am I concerned with these figures? No. Because I am not de-recognizing any net assets. I'm not de-recognizing any goodwill. So that information doesn't concern me. It says entity A initially accounted for NCI, representing the present ownership interest at a fair value, and it recognizes the subsequent changes in the subsidiary at a proportionate share in the net assets. So NCI at the time of acquisition as per 103 was taken at a fair value because you've got a choice, and then you added a share in the post-acquisition earnings. Okay. Now, how should the entry be accounted for? Now, watch me carefully, friends. Since you made a sale of the shares, the bank gets a debit to the extent of the sale proceeds. So we've sold this at 500 crores. So the bank gets a debit to the extent of 500 crores. The NCI, which was not there in the books of accounts earlier, because you had 100% stake, now there was 0 NCI, but suddenly the NCI now comes to a 30%. So you need to create an NCI now. When you go to create an NCI, what do you need to do? What do you need to do? You need to be very careful at this particular stage. Now, please hear me carefully. Please hear me carefully. Your calculation of the NCI was at a fair value. And if you remember in Index 103, I gave you that if NCI is taken at a fair value, the goodwill is a full goodwill. When I say a full goodwill, it means that the amount of goodwill in the balance sheet represents the share of both the majority and the NCI. I repeat. When you say that NCI is taken at a full value, this indicates that the amount of goodwill is full. I think, let me just put that chain across so that there is no confusion. So we can just put that chain of thought very clear in the mind. So let's put it like this. So when you take the NCI at a fair value, then in this particular case, you get a full goodwill. And when you say full goodwill, it means that this is a goodwill which is belonging to both the parent company as well as the NCI. So both the parent company share of goodwill and the NCI share of goodwill is appearing in the balance sheet. But when you take the NCI at Pasna, then I told you that this is called a partial goodwill. This is called a partial goodwill. And in this particular case, it is only the parent company share which is appearing in the balance sheet. The NCI share of goodwill is not appearing in the balance sheet. Let's get the chain very clear. Your calculation of the NCI decides that the goodwill is a full or a partial goodwill. If your NCI is taken at a fair value, the goodwill appears in the balance sheet is the full goodwill, which means the goodwill appearing in the balance sheet is both the parent and the NCI share in the goodwill. But if the NCI is taken at Pasna, the goodwill appearing in the balance sheet as a partial goodwill, it only represents the parent company share of goodwill. The NCI share of goodwill is not appearing, which means, moral of the story, now catch this carefully. If your NCI is taken at a fair value, please say this very carefully. Please say this very carefully. If your NCI is taken at a fair value, then you can take the NCI at net assets plus goodwill into the percentage, which is 30%, if your NCI is taken at a fair value. So since you're taking your NCI at a fair value, so the goodwill is a full goodwill, then you can take the NCI at net assets plus a goodwill into 30%. But if the NCI is appearing at a Pasna, please don't take this goodwill because that is not appearing in the balance sheet. So if your NCI is taken at Pasna, because this is one area where a lot of students commit a mistake. Sometimes professionally also, we do commit mistakes on that. So you need to be very careful that if your NCI is taken at a fair value, your NCI will be net assets plus goodwill into your share. But if your NCI is taken at Pasna being a partial goodwill, NCI will only be recorded at the share in the net assets on the date of disposal. I hope you got the point very clear. Right? So this is a very crucial point indeed. So you need to be very careful in this particular case. So in this case, when it says that the NCI is supposed to be taken at a fair value, so this information is of immense importance. That if the NCI is taken at a fair value, then you need to consider net assets plus goodwill because goodwill is full. And if the NCI is a Pasna, you're going to take the NCI at the share in the net assets because the goodwill is supposed to be partial. The goodwill which appears in the consolidated balance sheet is only the parent share. It doesn't belong to the NCI. So in this particular case, now what do? We are given the net assets is 1300 crores and additionally there is a goodwill of 200 crores. So we can take this figure as 1500 crores. 1300 plus 200 into 30% NCI, that works out at 450. So the balancing figure 50 is the credit which is going to be recorded directly in terms of SOKI, that is equity. So this is the agenda which you need to consider. So the only caution in terms of this entry is the NCI computation. So remember the basic facts that bank gets a debit to the extent of the sale proceeds. NCI needs to get a credit, which is to the extent of all dependent upon whether the goodwill is partial or whether goodwill is full. Accordingly, you calculate NCI and then get a balancing figure, which is supposed to be taken to equity. Okay. So far, so good on this. Now, I think let's take it further. So this was one example which we are done. Sometimes the examiner may also be interested in, testing a little more knowledge. And what he would do is something which is given in question number 9 in the study material as well. I'll tell you what he's up to. What he'll do, he will give you a consolidated balance sheet already in the question. So he will give you, let's say, a consolidated balance sheet already in the question. And after giving that consolidated balance sheet, what do you need to do? You just need to incorporate the entry for disposal and you need to give a new consolidated balance sheet. So he will give you an existing consolidated balance sheet. Just incorporate this entry as a part of the existing balance sheet, and you'll be able to get a new consolidated balance sheet. Because he wants to test your knowledge that due to the disposal, did the goodwill change? Due to the disposal, what changed? So you just not need to do one thing. Whatever is the existing balance sheet, just incorporate this entry and you get a new consolidated balance sheet, simple and straight. Okay. So this was one area of question where there was no loss of control. Let's, I think, do another question with you where there is a loss of control. Let's, I think, pick up question number 10, which is mock test paper, that is April 2019. So let's have a look. Now remember, we are on a case where there is a loss of control. And if there is a loss of control, in this particular case, we are working on the reversal entry in terms of Ind AS 103. So let's take it further. Okay, so let me just read the inputs to you and then we'll solve this. It says a parent purchased an 80% interest in the subsidiary on 1st April X1 when the fair value of the net assets is 175. And then it says goodwill of 20,000 arose on consolidation under the partial goodwill method. Ahaha. So the moment you look at the concept that there is a partial goodwill, your mind should tell me that NCI is taken at PASNA. Because if it is full goodwill, NCI fair value. If it is partial goodwill, NCI is at PASNA. Okay, so it says a parent purchased 80% interest for 160 when the fair value of the net assets is 175. So I think I just want to make a cross check as well. If I want to just make the calculations of goodwill, I would say the purchase consideration is 1,60,000, and to this you can add the NCI. So NCI will be 20% of the net assets because we're taking PASNA. So 175 into 20%, it works out at 35. So PC plus NCI is 195 compared to the net assets, which is 175. So compared to the net assets, which is 175, you can easily derive the goodwill, which is to the extent of 20. So though the goodwill is already given in the question, but I just made some calculations for better understanding. So he says the goodwill of 20,000 arose on consolidation under the partial goodwill method. An impairment of goodwill 8,000 is charged in the consolidated financial statements. That means presently the goodwill appearing in the books of accounts is 12,000 because you've already impaired the goodwill. So at the time of disposal, the goodwill as a part of the books of accounts is 12. Then he says no other impairment charges have been recorded. The parent sold its investment in the subsidiary on 31st March X4. So it seems that there is a complete disposal from 80%. You've sold its investment. It's a full disposal. And then it says the book value of the subsidiary's net assets in the consolidated financials is 225. And this is not including the goodwill of 12. The net assets are given separately, and that is excluding the goodwill. When the subsidiary met the criteria to be classified as held for sale under 105, no write-down was required because the fair value less cost to sell was greater than the carrying value. I guess that's also worth making a mention that when a company is planning to sell a subsidiary, it would also trigger the applications of Ind AS 105. Because till the time the company is actually disposed of, the consolidation will be done by using Ind AS 105. It's not going to be a normal consolidation of assets and liability line to line, but you need to apply the principles of a discontinued operations for an income statement, and you need to apply the concepts of non-current assets held for sale. It could be a very interesting question to watch, that when a company is a parent company is planning to dispose of a subsidiary and the subsidiary gets classified as a DG, a disposal group which is held for sale. How does a consolidation take place in a balance sheet? How does a consolidation take place in an income statement? Wow, that could be a separate indeed chapter as well. Am I speaking too technical today? Maybe. So I'm just giving you some deeper thoughts of, the advanced kind of problems which one could confront. Okay. So it says when the subsidy met the criteria of 109, 105, no write-off was required. So when it triggered 105, no accounting treatment was done under Ind AS 105. The parent carried the investment at cost as permitted by Ind AS 27. In the separate financial statements, Ind AS 27 is applied for the investments and that was taken at cost. Calculate the gain or loss on disposal in the subsidiaries, separate financials and in the consolidated financials. So I think let's solve this question. So first we'll look at the entry with reference to the consolidated financials, and then we'll look at the entry from the point of view of separate financials. So let me just add it out here. So I'm looking at the question number 10. So let's have a look at the question number 10. So first of all, let's do one thing. Let's organize the entry with reference to the reversal entry as per Ind AS 103. So we've got two focus points. We're looking at the disposal entry. One is from the point of view of consolidated financials, and one is from the point of view of separate financials, because he's asking you to calculate the profit or loss on disposal, both for the consolidation and the separate financials. So here, let me first put a basic entry. Bank gets a debit to the extent of the sale proceeds. Then investment retained, if any, gets a debit. Then NCI needs to be derecognized. Then net assets needs to be derecognized. The goodwill needs to be derecognized. So get the basic entry in front of you. The bank is a debit. The investment retained is a debit. The NCI derecognized, goodwill and the net assets also derecognized, and the balancing figure gain or loss. Now let's begin. If you look at the data which is given in the question, I am given that in this particular case, we disposed of the entire subsidiary, and this is disposed of at 2 lakhs. So this is the disposal amount, the proceeds clearly given. Next, I am also given that if you look at the net assets of the company without goodwill, it is appearing at 2,25,000. That's 2.25 lakh. I think let's put the figures in wholesome numbers. So let's consider the bank is a sale proceeds of 2 lakh. The net assets in the books of accounts is 225. And I'm also given that this is excluding the goodwill to the extent of 12. Then next, if we look at the information, and that is with reference to the NCI. Now, in this particular case, be careful. As far as the NCI is concerned, it is PASNA. May I take the liberty of asking you that since the NCI is taken at PASNA, are you going to consider 225 into the percentage or 225 plus 12? This is a case of a partial goodwill, so the NCI is measured at the share in the net assets without a goodwill. So in this particular case, we consider the net assets is 225 and the NCI was 20%. So this works out, I guess, at 225 into 20% NCI, that's 45,000. There is no investment which is retained, so that becomes 0 because we've not retained any investment. So let's see what is the balancing figure in this entry. That's a gain or loss. So that's going to be a total of 245 minus 225 minus 12. So we're getting a balancing figure 8,000 in this entry. And this will be taken in the profit and loss. This is a gain which is arising on disposal from the point of view of the consolidated financial statements. Simple. Now let's go to the separate financial statements where a normal entry will be done. The bank gets a debit, the investment gets a credit, and just like you do the normal IGAAP accounting, a normal IGAP accounting will be done. The bank is debited with the sale proceeds, the investment with the proportionate original cost. The proportionate original cost. So the bank is to the extent of we sold the investment at 2 lakh rupees and the investment will get a credit at the proportionate original cost. We acquired the investment at 1,60,000 and we've sold the entire investment. Since we've sold the entire investment, so you give a credit of 160 to the investment account and you get a balancing figure that is 40,000. This is the profit on sale. So the gain on disposal for the separate financials is 40. For the consolidated financial statements, it is coming to 8,000. As simple and straight. So basically the focus is when the control is lost, you just need to focus on the reversal entry of 103 and you get the results. Okay. Now let me ask you friends, do you want me to do another combination in this case? You want me to do another combination on the loss of control, or would that be good enough and we can start focusing on Index 11? Your choice. I've just taken one sample, but the questions, of course, are going to be on the similar lines. So you want me to focus more on the areas of loss of control. I have got a very deadly kind of question, but that can take a lot of time as well. This is a very deadly question. So I think we'll keep this question pending, because if I take this particular question, then I think I am going to take a lot of time on that. Okay, so I think the concept, the broader concept in terms of accounting is done. But let's, I think, quickly do a mind mapping. So that let's give you some inputs now, because I think I want to do some finer tuning to you at this stage before we take it further. So let's quickly take 5 minutes and take a little consolidation of this section. Then we go to Index 11. Yes, we're going to do that. So let me just quickly give you some inputs further. Certain key aspects, certain key points which you need to keep in mind, the finer tuning which I am doing. The finer tuning which I am doing now at this stage. Now watch this carefully. You know, the finer tuning is that I am only concerned with basically, you can say, 2 areas. One is that there is no loss of control. So I'm just giving you some finer tunings where people generally go wrong. So let's, I think, give you the final tuning in terms of certain key points. Now, if you're looking in terms of, a situation that there is no loss of control, the entry is a bank gets a debit. If it is a case of disposal and the NCI gets a credit, or vice versa. Or it is vice versa, depending upon the percentage is increasing or decreasing. Bank would never create a problem. Bank would never create a problem. Now, the main focus point is the NCI figure. You need to watch out in the question that if the goodwill is full and if the goodwill is partial, you need to accordingly decide the valuation of this NCI. If the goodwill is full, it indicates that NCI was taken at fair value. And if the goodwill is partial, it indicates that NCI is taken at PASNA. So this is the immediate thoughts which should come to the mind. So the examiner could tell you this information or this information, you should know that goodwill is full, NCI fair value. Goodwill is partial, NCI is supposed to be PASNA. So accordingly, when you take the calculation of the NCI, in this case, it is net assets plus goodwill into the percentage. And if you're taking this situation, it is simply the net assets into the percentage. So that's what you need to be careful. That when you're considering the NCI value, you need to be careful in terms of including or excluding goodwill as the case may be. And the second key focus point in this case is that any balancing figure in this entry is directly taken to equity and not to the P&L. So the focus is NCI, the focus is in terms of the balancing figure going to equity. Done. Now, when you come to the case of a loss of control, I would say the main focus is reversal entry. You need to go in for a reversal entry of Ind AS 103. You need to focus on that. You need to reverse the entry in terms of 103. And in this particular case, the bank gets a debit. And this will be easily available because this is the amount of the sale proceeds. 100% will be given in the question. There cannot be a challenge. The other one is that there is an investment which might be retained. And this investment retained is going to be taken at a fair value. And this will also be directly, indirectly, most probably directly given to the question. He will clearly tell you that this is the amount of fair value of the investment which you need to record. And then NCI is got to be derecognized. And here again, a caution plays. Here again, a caution plays that when you derecognize this NCI, you need to see that is it taken at a fair value or is it taken at a PASNA, and accordingly a derecognition value will be decided. Trust me, when you're going to do the practical illustrations, this mind map is going to be of very immense use. So if the NCI is at a fair value, you take the net assets plus the goodwill into the percentage. And if you take it at PASNA, you take the net assets into the percentage. So when you calculate the amount of NCI to be derecognized, be careful, is it fair value or is it PASNA? Accordingly, you need to take either including goodwill or you need to take it excluding goodwill. And then thereafter, in this particular case, you need to go in for a derecognition of the net assets. And this will be at the book value, which is appearing on disposal. This will be clearly given in the question. There will be no challenge. And then in this particular case, the goodwill will be given a credit. And this will also be at the book value appearing in the consolidation. So the goodwill and the net assets will be directly given in the question. NCI, you need to be careful. Investments and the bank figures will be directly given in the question. And the second focus point is that the balancing figure in this entry is going to be taken to the P&L, gain or loss. Now you can try out questions on the various permutation combinations in the study material on this particular area. Index 110 is done. Now we are going to go to the next standard, and that is Index 111, that is joint arrangement. So let's begin the journey. Okay, so let's start the journey now in terms of Index 111, a pretty easy standard. And we are going to develop step-by-step models out here to understand the standard very well. Okay, so let me now come to the standard on Index 111. Now, before I start off with this standard, I need to first of all give you an overall picture that how we are going to proceed with this standard. And then I'm going to work upon the chain of thought. For the ease of understanding what I've done, I've divided this entire standards into a three-step model. Now, you would actually say, this man is too fond of three steps. Because you must have seen that, everywhere, whatever, topics I've covered with you, I've converted everything into a step-by-step approach. And converting it into a step-by-step approach is, of course, a difficult task. But it makes things very easy because, when you're doing questions, especially in the exams or even in a practical life scenario, your thought processes are very focused when you're doing on a step-by-step. You know that in this step, these are the important considerations. So based on my own understanding and based on my research, what I've done, I've again translated this standard into a three-step model, and you're going to see a lot of three-step models in this particular standard. Let's begin the journey. So I'm going to first of all give you a thought process in terms of the overall three-step procedure. So we're looking at Index 111, and this is called joint arrangements. This is called joint arrangements. So we're looking at Index 111, and the name of the standard is called joint arrangements. Now, before we understand what is a joint arrangement, let me give you that if you need to understand the standard, you need to understand this in a three-step model, which makes life simple. Step 1, step 2, and step 3. The first step we are going to work upon is that is the arrangement. The first step we're going to work upon is that is the arrangement a joint arrangement? So the first question which we're going to put across is that what are the parameters on the basis of which we will say that yes, it is a joint arrangement. So we're going to first of all focus on this area. Second, once you decide that yes, it is a joint arrangement, you go to the step number 2, and then you need to decide what is the type of joint arrangement. So we need to decide that what is the type of the joint arrangement, and Indus 111 tells us very clear that the joint arrangement can be of two types. One is called a joint operation and one is called a joint venture. So there are certain parameters on the basis of which we will decide that is it a JO, a joint operation, or is it a JV, that is a joint venture. So this will be our second focus point. And then after this, once you decide this, we go to the accounting of these joint arrangements. And let me tell you in advance that as far as accounting of a joint operation is concerned, it is covered under Indus 111. But as far as the accounting of a joint venture is concerned, it is covered under Indus 28. So the moment you decide that it is a joint venture, you are out of the standard. So the moment you say that this joint arrangement is supposed to be a joint venture, a JV, you are out of the standard and you need to do the accounting under Indus 28. I'm looking at the consolidated financial statements accounting. I'll give you a very beautiful chart in the terms of accounting because there is something very interesting. I'm going to give you a complete chart on the accounting in terms of a joint operation, joint ventures, separate financials, consolidated financials, etc. So we have got an overall three-step model in terms of understanding the standard. So you need to first of all understand that is a given arrangement a JA? If I say yes, you need to decide that is it a JO or a JV. And once you say that it is a JO, you decide the accounting under this standard. And if it is a JV, the accounting is covered under Indus 28. So let's begin the journey and let's begin with the step number 1, that how do you decide it's a joint arrangement, for which I am going to again create a three-step model. Oh my God. So I'm going to give you a three-step model here. I'm also going to give you a three-step model here. I'm going to give you a chart which I'm telling you in advance right now. So based on the overall three-step model, I'm going to give you a three-step model on step 1. I'm going to give you a three-step model in step 2. And then I'm going to give you a chart. And that's the end of the journey in terms of Indus 111. So let's begin with the step number 1 with a three-step model. For that, I need to take you to the standard. I've just, taken some inputs and I am just going to take you back on a few inputs which are given in the standard. So let me just share certain insights and we're going to create a three-step model on that reading. So I want to first of all show you the inputs which are given in terms of the para number 4 and in terms of the para number 5. So let's have a look in terms of the para number 4 and the para number 5. Let me just read something to you. It says in terms of the para number 4, a joint arrangement, that is a JA, is an arrangement of which two or more parties have a joint control. It says it is an arrangement. It is an arrangement in which two or more parties have a joint control. Then it defines in para 5, a joint arrangement has got the following characteristics. Number 1, the parties are bound by a contractual arrangement, CA. And then there is a clause number B, which I think I might have just deleted. No, I'm not. I'm just going to expand this bit. So there is a clause number B as well in para number 5. And that clause number B tells me that in this particular case, the contractual arrangement gives two or parties a joint control, that is a JC. I use these short terms. So one thing is very clearly coming out of the para number 5, that when you say that there is a joint arrangement, you need to see that there is, number 1, a contractual arrangement, and number 2, there is a joint control. The para number 5 brings out the characteristics of a joint arrangement, and it very clearly tells you that there are two main characteristics. The parties are bound by a contractual arrangement. So you need to see, is there a contractual arrangement? There is one. Then you need to see that is there a joint control in that arrangement? There is two. So to begin with, there are two questions I need to put across. I'm going to put across the question number 1. Are there two or more than two parties? Mind the language, I'll give you the notes later. So are there two or more than two parties bound by a contractual arrangement? If I say a yes, I go to the step number 2 and I say, okay, do the parties have a joint control? If I say a yes, then it's a joint arrangement. I don't know as of now what is a CA, a contractual arrangement, or what is a JC, there is a joint control. We'll see that. So I think let's have a look at what is a joint control. So the para number 7 defines what is a joint control. It says it is a contractually agreed sharing. It is a contractually agreed sharing of control. So when I say sharing of control, we call it as collective control, CC. So when I say that it is a sharing of control, it is called CC, that there is a collective control which exists only when decisions about the relevant activities require a unanimous consent, UC, of the parties sharing control. So basically, a joint control is going to be a sum total of a collective control and a unanimous consent. Don't worry. We'll take a good number of examples to make the chain very clear to you, but just keep one thing in mind, that when you're looking at a concept of a joint control, you need to put across a question number 1, is there a collective control? If I say yes, I say, okay, is there a unanimous consent? So you need to prove that there is a agreed sharing of control called a collective control, and there is to be a unanimous consent called a UC. Now we can see that this is step number 1, this is step number 2, and this is step number 3. We are going to put across 3 questions on a chronological order. In order to make an assessment that there is a joint arrangement, I'm going to put across a 3-step model to myself. Don't worry, what do we need to see within those steps is something which I'll elaborate. But first, let's get the chain of thought very clear, that what is the sequence in which the questions need to be put across. You need to put across a question number 1, that is there a contractual arrangement? I say yes, there is a CA. I need to go to the step number 2 and say that, okay, is there a collective control? I say a yes, then I go to the step number 3, is there a unanimous consent? I say yes, I said, okay, it is a joint arrangement. Now let's understand each one of them, that what is a CA, what is a CC, and what is a UC. Okay, so let me just come out and let's create a chain of thought back again. So we've decided on a conceptual levels that when I'm looking at a joint arrangement, JA, you need to see that it is a contractual arrangement, plus it is a collective control, and it is a unanimous consent. This is indirectly called a JC, that is a joint control. Let me put down the inputs as well to you, so we can actually now say that when I'm looking at a CA, it is a contractual arrangement. At least for the first time, I'm going to put the complete nomenclature. So you need to see that is there a contractual arrangement. When I'm looking at CC, it is a collective control. It is a collective control. And when I'm looking at UC, it is supposed to be unanimous consent. It is supposed to be a unanimous consent. And undoubtedly, when I look at a JA, it is supposed to be a joint arrangement. It is supposed to be a joint arrangement, that is JA. And of course, we're making a mention that if we're looking at JC, it is supposed to be a joint control. So these are the terms which we are using. Now, let me explain a bit on each one of them. We'll take good examples to make it very clear. Now, when I say that there is a contractual arrangement between the parties, I would say the parties, by way of an agreement, written or oral, have agreed to the terms and conditions of the contract. So you need to see that, the parties to the contract. So let's say there are two parties, minimum parties will be at least two. So you can say in a contractual arrangement, there will be a minimum of two parties. It can be three, it can be more than three, whatever, but there will be at least two parties who have agreed contractually. So what is a contractual arrangement? That they've agreed on the terms and conditions. They've agreed on the terms and conditions to act jointly. So in this particular case, all I need to see that two or more parties have agreed on the terms and conditions of the arrangement. So there should be a mutual agreement on the terms and conditions of the arrangement. That's it. So we need to see that have they entered into an agreement, understanding the terms and conditions of how the arrangement is going to work, their rights, their obligations. So they document the rights and obligations of the parties. So everything is documented, preferably in a writing. It can be oral, but preferably everything gets documented. Now, let's see what is a collective control and what is a unanimous consent. Now, hear me very carefully, because this is one place where people generally go wrong. I'll explain a bit in English and Hindi both. I'll give you complete English words also. I'll give you Hindi as well, but you'll understand it very quickly, sometimes when you get those words. So I'll use both of them so that everybody can understand it very well. When I say collective control, I cannot take decisions independently. मैं decisions अकेला नहीं ले सकता. Collective control. I cannot take decisions. I cannot take decisions alone. I cannot take decisions alone. This is the key question you're going to put across. Collective controls means that I cannot take decisions alone. I have to involve other people. I do not have a control. In simple words, I don't have a control. I cannot take decisions alone. मैं अकेला decision नहीं ले सकता. मजबूर हूं. सामने वाले की मुझे decision लेनी पड़ेगी. मैं कहूंगा आप हाँ कर दो. आपके बिना मैं अकेला डिसीजन नहीं ले सकता. It is a collective control. Now, when I say unanimous consent means मेरे बिना आप डिसीजन नहीं ले सकते. Without me, you cannot take a decision. So I can block decisions. I can block decisions. This is very important. And these are two different things. Trust me, these are two different things. मुझे आपकी मदद चाहिए और आपको मेरी मदद चाहिए. Are you getting the point? मुझे आपकी मदद चाहिए. आप हाँ बोलोगे तो बात बनेगी. भाई साहब, मेरी भी हाँ उतनी इंपॉर्टेंट है. Now you will say, sir, I didn't really understand. What do you say that, there is a collective control. I can't take decisions alone and I can block decisions at the same time. Let's take a very simple example to understand this concept. Let me just take a simple example. There are two parties, A and B, and they have got a 50-50 stake in a company. Let's say there are two parties in an arrangement. So they entered into a contractual arrangement, documenting the terms and conditions of the agreement. Now, they decided that every time they need to take decisions, we need a majority to agree. The arrangement says that every time they want to take decisions on relevant activities, we need a simple majority more than 51. Can he take decisions alone? No. Can he take decisions alone? No. Can he block the decisions taken by B? Yes. Can he block the decisions taken by A? Yes. There are two different things. Get this very clear. A cannot take decisions alone. He needs to ask the permission of B. Do you agree? So at the same time, if I need his permission, he also needs my permission. Okay, let's take another example to make it very clear. Let's say A and B, they've got 60, they've got 40. I need majority to take a decision. Do you think A can take decisions alone? Yes, he can. Yes, he can. Do you think A can block decisions taken by B? Yes, he can. But I don't need to ask the second question. The moment you say that A can take decisions alone, there cannot be a collective control. It's a control. It's a control. So in this particular case, can B take decisions alone? No. Can he block decisions? No. He can't even block decisions. So if you look at the B perspective, can he take decisions alone? B cannot take decisions alone. But can he block decisions? He cannot. He is not in a position to take decisions alone, but at the same time, he can't even block other people. So there is a two-way traffic in terms of a joint control. मुझे आपकी जरूरत है, आप हाँ करो, आपको मेरी जरूरत है, मेरे बिना आपका काम नहीं चलेगा. इसका मतलब मैं अकेला कुछ नहीं कर सकता, मुझे आपकी डिसीजन चाहिए. आप भी मेरे बगैर कुछ नहीं कर सकते, आपको भी मेरी डिसीजन चाहिए. So collective control means I cannot take decisions alone, and unanimous consent means I can block other people's decision. If I cannot block other people's decision, I am not a party to the joint control. Let's do one thing. Let us concentrate on examples of joint control. I'm going to give two charts to you. And in chart number 1, I'm going to consider two parties with some permutation combinations. And in terms of the second chart, I'm going to give you three parties. I'm not going to take more than three, but we'll do two charts with you. Chart number 1 containing two parties assessing a JC. We'll look at the CC and the UC. And we'll give you another chart for three parties, which will give you a complete clarity in terms of a joint control assessment. Let's do one thing. Let's create a chart with you. So once I'm done with the chart, trust me, you're going to get a complete clarity of thoughts in this particular case. So let's begin the journey. So I'm going to create a chart now where I'm going to create some permutations, combinations. So let's create some permutation combinations. And we're going to consider two parties, A and B. And I'm going to consider the aspect whether there is a collective control or not. So let's take it like this. So let's give you the permutation combinations out here. So I am considering particulars. I'm looking at the concept of collective control, unanimous consent, combined is the joint control, and then we're going to give remarks. So let's give you permutation combinations in this case. If you're able to answer the inputs in this chart, two parties is done. So this is my chart number 1, where I'm focusing in terms of only two parties to the arrangement. I'm assuming the contractual arrangement is already there. I'm considering the contractual arrangement is already there. We're just focusing on the assessment of a joint control. So let's consider two parties. We've got A and we've got B. Combination number 1, he's got a 50%, he's got a 50%, and we need majority to take a decisions. We need a majority to take a decision. Now, majority means we need at least 51% votes to agree. Now, let's put across a question. Do you think A or B can take independent decisions? No, they cannot take independent decisions. So no one can take independent decisions. So the answer is, okay, let's put it like this so the confusion is not there. So we're looking at, in the brackets, I'll put it, can they take decisions alone? So the question which you need to put across is that, can they take decisions alone? The answer is no, they cannot take decisions alone. A alone cannot get a majority, B alone cannot get a majority. So this implies collective control. This implies a collective control. Let's go to the next one. Unanimous consent is, can they block decisions? Can they block decisions or not? Can they stop other people from taking decisions without them? Can A block the decisions taken by B? Yes, he will say, you need to take my consent, boss. Can B block the decisions by A? He would say, yes, you need to take my consent. So yes. So when I say a yes, it implies a unanimous consent. It implies a unanimous consent. So you are not able to take decisions alone. There is collective control. You can block decisions, implies a unanimous consent. So this implies that there is a joint control. I hope the first example is absolutely clear. Let's look at the second variation. Let's look at the second variation. And the second variation we're considering is that A has got 60 and B has got 40. Or let's consider first of all a similar case. Let's consider 50-50, but I need 75% to take decisions. Does the answer undergo a change? If you need majority to take a decision, or if you need a 75%, does the answer change? No, the answer would not change. It is still a joint control. So let me make a conclusion at this stage and make a strong statement. If there are two parties with a 50-50 stake, and you need a majority or you need a certain specified percentage to take decisions, it always is a joint control. See, if there are parties with a 50-50 stake and you need a majority or a certain specified percentage, I think it is always a joint control. So I can say, if there are two parties with equal percentages, if there are two parties with equal percentages and we need to take decisions, based on majority or based on a specified percentage, it is 100% a joint control, undoubtedly. So that is the moral of the story, that if there are two parties with an equal percentage, you can say if they need to take a decisions on a majority level or they need to achieve a certain specified percentage like 75%, it is 100% joint control. It can never be a case of control. Let's look at more combinations now. Let's consider the combination number 3. Let's say A has got 60 and B has got 40 and they need to take a majority. They need to take decisions by majority. Now, let's see. Can A take decisions alone? Yes, he can take decisions alone. A can achieve a majority. He can take decisions alone. This means there is a control. It is not a joint control. So I don't need to put across this question. We can say it's a clear-cut case of control. It's a clear-cut case of control. Let's go to the next combination, number 4. So let's have a look at the next permutation combination. Let's say this is again 60 and this is 40 and you need a 75% decisions. You need 75% majority to reach a decision. Can A take decisions alone? No. Can B take decisions alone? No. Nobody can take decisions alone. It implies a joint control. Sorry, I would say it implies a collective control. It implies a collective control. A cannot take decisions alone. B cannot take decisions alone. Can A block decisions by B or can B block decisions by A? Yes, they can block decisions, and this implies a unanimous consent. So there is a joint control. So you can see another very interesting inputs coming in, that if there are two parties with unequal percentages, it depends, there may be a control or not. So if you look at this case, we can say two parties with unequal percentages, two parties with unequal percentages, can I say it depends? Depends upon the case, it may result in a control or it may result in a joint control. And trust me, friends, there cannot be any fifth permutation combination. If there are two parties to the arrangement, there are only four permutations you can see in the chart. Either they've got an equal percentage, 100% joint control. If they've got an unequal percentage, it depends upon what percentage we need to achieve in order to take a decisions. So it could be a control by one, it could be a joint control by two. I guess I am pretty clear, friends, at this stage. I guess I am pretty clear. Yes, I think I'm getting answers correct on that. Great. So this is the chart number one. Now let's go and create a chart number two to give you clarity. If there are three parties, then what happens? Let's create a chart number two. So I'm now going to create a chart number two where the focus in terms of chart number two is going to be three parties. So that could make things a little more interesting. So let's have a look at three parties now and let's create a chain of thought. So let me just create a chart. So we're going to create combinations out here. So let's take a column for the particulars and we're going to consider the collective control, unanimous consent, and we're going to consider the remarks as well. So let's consider the particulars and let's consider there is a collective control, a unanimous consent, part of the joint control. And let's consider the remarks and see what kind of position is coming in. And you're going to see some very interesting combination coming in this case. Watch this carefully. Now let's consider there are three parties, A, B, and C. So let's say there are three parties. The first combination, let's say A is got 50, B is got, let's say, let's take a little change. Let's first create a good combination. Let's consider this is 30 and let's say this is 30 and that makes it, I guess, 40. So let's take a combination 30, 30, 40. So they've got a 30, 30, 40% and I need a majority to take a decisions. I need a majority to take a decisions. Now let's put across the same question. You need to see that can A take decisions alone or not. Okay, let's not take a majority. Let's take it more easier. We'll do a little complications later. Let's say I need a 75% majority. Now ask yourself a question. Can A take decisions alone, B take decisions alone, or C take decisions alone? No, nobody can take decisions alone. That means it is a collective control. Nobody can take decisions alone. It's a collective control. Now let's see. If B and C join together, they achieve a 70%. Can A block decisions? Yes. If A and C join together, can they take decisions? Can B block the decisions? Yes. If in the other case, A and B join together, they achieve a 60%. If A and B join, C can block them. If B and C join, A can block them. If A and C join, B can block them. Nobody can create any combinations and everybody is in a position to block each other. So can they block decisions? Yes, they can block decisions. It implies a unanimous consent. So it is definitely a case of a joint control. Because in this case, they cannot take decisions alone is very clearly visible. And he can block because even if they combine, he can block. Even if A and C combine, he can block. Even if A and B combine, C can block. Every person can say, without me, you cannot take decisions. Then it is a unanimous consent. Let's look at the combination number two. Let's look at the combination number two. Let's consider the same case, ABC. And let's consider a percentage. It is 50, it is 30, it is 20, and let's say we need a 75% combination to take decisions now. Now that becomes a very interesting case. Now let me ask a question. Can A take decisions alone, or B take decisions alone, or C take decisions alone? Nobody can take a decision alone. There is a collective control, undoubtedly. Now be careful. Now we're looking at, can they block decisions? Now let's consider, if A and B join, they get 80%. Can C block decisions? No. If B and C combine, can A block decisions? Yes. If A and C join together, can B block decisions? Yes. A can block decisions if B and C join. B can block decisions if A and C join, but C cannot block decisions if A and B join. So which means that in this case, the unanimous consent is required, but the unanimous consent is required between A and B only, not C. C is not in a position to block decision. So the answer is yes, we need a unanimous consent of A and B, but we don't need a unanimous consent of C. So I would say it is a joint control where the joint control is with A and B, not C. C is a party to the arrangement without a joint control. So C is going to go to Index 28 and make an assessment whether he's got a significant influence or not. But he is definitely out of Index 111. Because in this case, the joint arrangement has got three parties. And you can say that in this particular case, A and B have got a joint control. So for A and B, we'll dig further that this joint arrangement is JO or JV. But in terms of C, we'll tell him you go to Index 28 and see if you've got a significant influence, then you can continue Index 28. Otherwise, you're out of Index 28 as well. And then you go to account as a passive investor under Index 109. So in this particular case, it is worth mentioning that C needs to check. C needs to check significant influence in this case and see whether Index 28 would apply. He is outside Index 111. Now you can see very clearly in this example that A, B, C cannot take decisions alone. C cannot take decisions alone, but at the same time, he cannot block decision. So the two elements of a joint control very beautifully brought out that, you cannot take decisions alone as one aspect. But the other one is that you should be able to block decisions. You are wanting other people's health, but nobody wants your help. So you're not a party to the joint control. Beautiful. Let's go to the third combination. So let's go to the third combination, and we're looking at A, B, C, and let's look at the percentage 50, 25, 25, and we need a 75% majority to take a decision. Now, this is again a very beautiful example, which is given in the standard as well, and that's going to give you a very good clarity of thought. Now, let me ask a question to myself. Can A or B or C take decisions alone? No, they cannot take decisions alone. It implies a collective control. If A and B join together, can C block the decisions? No. If A and C join together, can B block the decisions? No. But if B and C join together, can A block decisions? Yes. Which means A can block decisions. B cannot, C cannot. So we can say it is a yes as far as A, because A can definitely block decision. Because even if B and C combine, they need A. He can block decision that you please take my permission. But if A and C join, B is out of the picture. If A and B join, C is out of the picture. So A needs consent. A needs consent of B or C. He needs a consent of any one. So there are actually two combinations which could result in a joint control. So we can say there are two combinations which could result in a joint control. And the two combinations is either we go for A plus B or we go for A plus C. So these are the two combinations with which a joint control can be achieved. And now a very important input, the agreement has to state which combination will work. Since there are two combinations which will prove the concept of joint control, the arrangement, the agreement between the parties should tell me that either this combination is acceptable or this combination is acceptable. The agreement has to specify. The agreement has to specify which combination will be applicable. So this agreement must specify which combination is applicable. If the agreement does not specify which combination is applicable, nobody can apply Ind AS 111. Nobody can apply Ind AS 111 in that particular case. So if you say that the agreement does not specify that this combination is considered to have a JC, or this combination is a JC, ABC, everybody goes to Ind AS 28. Everybody is going to go to Ind AS 28 in this particular case. So what is important is that if you've got only one combination, like in the second one, you can say only one combination A and B is possible. So in this case, we can say only one combination is taking place. If it is one combination, there is no problem. The agreement does not have to specify that this combination is valid. But the moment there are two combinations which can achieve a joint control, the agreement has to very clearly specify which combination is valid. Otherwise, nobody is a part of the joint control. Nobody, ABC, can apply Ind AS 111. Wow. Let's take another combination, friends, with you. I'm just going to take it above a little space. I'm taking it above. So let's say there is A, let's say there is B, and let's say there are others and not C. Let's say there are others. Now watch this fourth combination very carefully. I'm not considering that there is A, B, or C. There is A and there is B, and there are thousands of other people. So let's say A is got a 50%, B is got 25%, C is got 25%, others have got 25%. We need a 75% majority. So A has got a 50%, B has got a 25%, others who are a lot of individuals. So these others are, none of each, none of them has more than 1% stake. So let's say none of them has got more than 1% stake in the company. So you've got a lot of people in that 25% others. Now let's consider again the assessment in this case. I need a 75%. Can A or B or C take decisions independently? No. So there is a collective control. If A and B join, can others block? No. If A and others join, can B block? No, which means the same status. It is the same status as point number 3. It is the same status what I covered in the point number 3. That means the point number 3 and 4 is treated same. Sir, but in point number 3, there is only one shareholder C. And here there are widely scattered people who have got 1% each. So do you think you're going to give the same answer? You're going to see that the agreement has to specify which combination is valid? Yes. Since the possibility is a combination of A and B and the possibility of A plus others, even though it may be A plus others, the agreement has to make a specification. The agreement has to very clearly say that the joint control is with A and B. If the agreement mentions that joint control is with A and B, it is a case of a joint arrangement. Otherwise, if the agreement doesn't specify neither A, B or the others, nobody could apply Ind AS 111. I guess I've made myself very clear now. You should be now able to understand the distinction between the collective control and the unanimous consent. So when you're looking at a collective control, the focus is that I need others' input. I can't take decisions alone. I need people to say that please agree with me. And at the same time, they should also tell me that please give your consent. It cannot be a one-way traffic for a joint control, that if I am begging others, please agree with me, they should also beg and tell me that please agree with me. If you are in a position like this, where you're begging other people agree with me, but they don't come and beg you and say that we need your decisions, you're out of the picture. I hope you get the point. So it's a two-way traffic in terms of things. So this is how the assessment of a joint control is done. So now the position is very clear. If I take you back, now I think we can clearly understand the three-step model in terms of a joint arrangement. So if I just quickly take a recap, I can say this is a step number one. You need to first of all understand that there is an arrangement, the terms and conditions of the arrangement between the parties, the rights and obligations is documented. Then you need to go to the step number two, which is a part of the joint control assessment, that there is a collective control. And then you go to the step number three and you look at the unanimous consent. So once the step 1, 2, 3 is met, it proves that there is a joint arrangement. That is step number one. But let me also tell you something more. In my examples so far, what I've done, the arrangement is being classified on the basis of that decisions are being taken on a voting power. Because we've taken the charts in which we've taken the percentages of voting power, and we're considering the decisions are taken on the basis of voting power. But sometimes the decisions may be taken by the board of directors and not on the basis of voting power. So the parties to the arrangement, they have, let's say, the right to appoint the board of directors. Then in that particular case, also a similar analysis will be done. I think we're going to talk of that similar analysis, but after the break. I think let's give you a break at the moment. And then we can talk a little more on that if the decisions in a joint arrangement is taken on the basis of the board of directors decision, then how do you identify that who's got a joint control? And then we'll come to the aspect in terms of the type of the arrangement. So I think let's give you friends a break at this stage. It's almost around 8:45 something. So 10, 12 minutes, we're going to see you back. First, let me see if there are any questions coming in so far. Okay, I think everything is clear. Wonderful indeed. So let's give you a break, friends, and we're going to join back after the break. Relax your minds. Welcome back, friends. So I hope you had a relaxation of mind. Now, I think let's take you to the next bit area connected to the first step, that we've seen how the joint control assessment is done when there is supposed to be a voting power which becomes the basis of decision, but appointment. But that's pretty simple. So I think let's create that combinations to you. So we're looking at the joint control assessment. We're looking at the joint control assessment, and I would say in terms of a joint control assessment broadly, there will be two cases. So one is if the joint control is on the basis of, you can say it is based on voting power. So if it is based on a voting power, that we've already seen that if the decisions are based on the voting power, you could refer the chart number 1 and 2, which I've just made. So then you can see that the joint control assessment, if it is based on a voting power, but if the joint control assessment is based on, you can say, decisions taken by board of director. Decisions are taken by the BOD, that is the board of director. Well, I guess in this particular case, what you need to see in this particular case that if there are, let's say, two parties and they can appoint equal number of directors and decisions are taken a majority, undoubtedly there is a joint control. So I would say that in this case, the typical situations could be that if, both parties, let's say in this case, both parties can appoint equal number of directors. So if they can appoint equal number of directors, then what happens in this particular case? Well, let me also tell you that in this case, the percentage of voting power will take a complete backseat. It doesn't make a difference, let's say, for example, party A has got a 60% voting power. I mean, I'm not concerned with that. The percentage has got no role to play. You'll only say that, okay, if both the parties can appoint equal number of directors, it would definitely imply a joint control. But if you say that both the parties can apply, or let's say one party or both parties, let's say both parties can appoint unequal number of directors. So we can say they can appoint unequal number of directors. So if it is unequal number of directors, then I guess it would generally be a case of a control. Because whosoever can appoint more number of directors has got to get a control. So the chances are highly likely that, one party gets a control. So the chances are more likely that one party gets a control in this particular case, because the party which can appoint more number of directors will get a control in that case. But there could also be sometimes that he gives you the status of the number of directors to be appointed. But there is sometimes you'll see in the study material also questions that there is a casting vote by chairman. That there is a casting vote by the chairman. So you'll see in certain questions which are given in the study mat as well, that let's say, for example, both of them can appoint equal directors or maybe unequal directors. And in case there is a tie, then the casting vote of the chairman plays a role. Then I would say the control comes with the party who can appoint the chairman. So in this particular case also, I would say the party who can appoint the chairman. The party who can appoint the chairman. So the party who can appoint the chairman gets a control in this case. So number of directors appointment is not going to be important in this case. So you need to see that if one of the party can appoint the chairman who's got a casting vote, because if there is a tie, then the chairman vote is counted, then who can appoint the chairman gets a control over the company. So this is one, area where you could see that when decisions are taken by the board of directors, the voting power will not be a basis to decide who's got a joint control. So you just need to watch out that if the parties can appoint equal directors, it would generally imply a joint control. If they appoint unequal directors, the party who can appoint more directors, majority, is got a control. And if there is a casting vote of a chairman, then again, it's a case of control. The party which gets the right to appoint the chairman gets a control. So this is on my step number 1, where the decisions are taken on the basis of either a voting power, for which I've given you 2 charts, and when the decisions are taken by the board of directors. Okay, now let's come to the step number 2. Once you've taken a decision that it is a case of a joint arrangement, we now need to classify the kind of the arrangement. That is it a case of a JO or is it a case of a JV? So let me see if there are any questions coming in so far. Otherwise, let's take the journey forward. No, I think that's all going well. Now, this discussion which I'm going to do now with you, I'm going to first of all show you a flow chart, which is given in the appendix to the standard. And on that basis, I'm going to develop a 3-step model with you. So this is going to be a little more technical discussion as compared to the initial part, but it's pretty easy again. If you hear this carefully, you get the concept very clear. So let me do one thing. On the identification of the arrangement, I am now going to show you a flow chart which is given at the appendix. And let's have a look at this. Okay, so let me just, I think, zoom this chart a bit, and we're going to develop a 3-step model. It's a beautiful flow chart, which I'm going to convert into a 3-step model. So let's have a look at this chart, and I'm going to convert this into a 3-step model. Okay, let's have a look. Now watch this carefully. Hear me very carefully, because this is crucial. If you get it, you get the entire concept. Now, at the first instance, you can see we're looking at the classification of a joint arrangement. So in my discussion, it is the step number 2. You've decided that it is a joint arrangement. And now we need to decide that is it a joint operation or is it a joint venture? Now, before you apply a 3-step model, you need to first of all put across a basic question. Once you have reached a conclusion that it is a joint arrangement, you need to first of all put across a basic question that did you create a separate vehicle or not? So you need to put across a question that did you create a separate vehicle or not? In the sense, let's say there is a party A and B, or let's say there is A Limited and there is B Limited. They entered into a joint arrangement and they created a separate company that is AB. So I would say creating a separate company is like creating a separate vehicle. So when the 2 parties enter into a joint arrangement, the possibility is they do not create a separate entity, or they create a separate entity. So the first thing which you need to do, you need to first of all look at the question and decide that are they creating a separate entity or not? Are they creating a separate vehicle or not? So if you say that they are not structuring any separate vehicle, it is undoubtedly a joint operation. So when the 2 parties enter into a joint arrangement and they do not create a separate entity, they do not form a separate vehicle, it is clear-cut case of a joint operation. Next, if you say yes, they've structured a separate vehicle, they created a separate entity, you need to apply step number 1, step number 2, and step number 3, and accordingly, you will take a decision that whether it is a JO or a JV. So get this concept very clear. At the first instance, you need to put across a question, did I create a separate vehicle? No, JO, done. I created a separate vehicle, then I'll say, okay, let me apply a 3-step model in this particular case, and then I will take a decision that is it a JO or is it a JV. Now, in this particular case, what is the step number 1? You need to look at the legal form of the separate vehicle. Step number 2, you need to look at the terms of the contractual arrangement. And step number 3, you need to look at the additional facts and circumstances. Now, hear me very carefully. You know, when I am looking at the step number 1, that means I'm looking at the legal form of the separate vehicle. What is the thought process? Now, keep one picture very clear in mind, that when I am saying it's a joint operation, or when I'm saying it's a joint venture, what is the basic criteria of saying that it's a joint operation or a joint venture? The basic criteria is, if you can say that the parties and the entity created are separate legal entity. I put it again. If you can prove it to me that the parties to the arrangement and the separate vehicle created, so A and B are the parties to the arrangement and AB is the separate vehicle. If you can prove it to me that they are supposed to be having a separate legal entity, then it's a JV. But if you say no, that the parties to the arrangement and the separate vehicle are not separate legal entity, then it's a JV. So in the step number one, when you're looking at the legal form, you can have various permutation combination. Don't worry, I'll document the steps very soon. I'll give you the detailed steps soon, but just get the chain very clear. So when you're looking at the legal form of the separate vehicle, you need to see, did we create a company? Or did we create an LLP, or did we create a normal partnership firm? So this is one of the clarifications which is also given in the Indus bulletins as well. So when I checked up the Indus bulletins, there is a clarification which says that when you look at a legal form of the vehicle, these are the various ways in which a separate entity may be created. The two companies enter into a joint arrangement and create a separate entity. So I need to see that, is this a company, is this an LLP, or is this a firm? Now we know that when it is a company and an LLP, a separate legal entity is always met. Company is always considered a separate entity compared to the parties. An LLP would also ensure that the entity, the LLP firm, and the parties are separate legal entity. So if you created a company or an LLP, it is undoubtedly a joint venture. So when you look at the legal form and you say that, okay, I've created a company or I've created an LLP, I would say that it is apparently a legal form. It's supposed to be a separate legal entity. It's a JV. But when you create a firm, the separate legal entity doesn't get met. Partners and you can say the firm are not supposed to be separate legal entity. They're basically one and the same thing. So the firm or the partners are not separate legal entity. So in this particular case, I would say it's a joint operation. So in step number one, the focus is going to be on the legal form. You need to focus that the separate vehicle created, is it a company or an LLP, JV? If it is supposed to be a partnership firm, then it is a JO. Irrespective, now here they clear, irrespective, whatever you concluded in step one, you have to go to step two. You may conclude that it's a JV in step one. You may conclude that it's a JO in step number one. Irrespective, I am going to enter the step number two. Now, interestingly, I will look at the terms of the contractual arrangement. Now, what I'm about to say may sound a bit tricky to you, but the standard setters realize something very important. Sometimes things look at the face of it different, but when you start digging into details, you find something different. So when you look at the face, this is the legal form. You're looking at the face of the transaction, that yes, you've created a company, okay, separate legal entity. You created a firm, okay, it's not a separate legal entity. So the step number one is more like a litmus test where you're accepting things on the face of it. But parties at some times may try to manipulate things. So what they may do, they may enter into a contractual terms which may try to violate the spirit of the legal entity. Now, I'll tell you something interesting. When you create a company, for example, or when you create an LLP, for example, what do the shareholders or the partners get? They will get a share in the net assets in the entity. They will get a share in the net profits of the company. So you can see that when you create a company or when you create an LLP, so what do the shareholders or what do the partners in the firm get? They will get a share in the net assets. They're not going to get a share in the assets. They're not going to get obligation towards liability. They will always get a share in the net assets. They're not going to get a share in the revenue. They're not going to get a share in the expense, but they're going to get a share in the net profits of the company. But let's say if you create a firm, the partners are going to get a share in the assets and liability. They're going to get a share in the revenues and expenses. They may agree to share the assets in a different proportion. They may agree to share the liabilities, bear the liabilities in a different proportion. They may agree to share the revenues in a different proportions, and they may agree to share the expenses in a different proportion. So the arrangement works out like this, that when they create a firm, they are getting a right to assets and obligations on liability. They're getting share in revenue and expense, but a company organizes things that you get share in the net assets and net profit. So sometimes as a part of the manipulations, what the parties might do, that they may create a company on a very apparent level, on the face-to-face level. But by virtue of their contractual arrangement, they may try to override the spirit of the legal form. So we'll have to see that if they entered into the contractual terms, if the contractual terms are clear, and I come to know that they are getting a share, the parties are getting a share in the net assets and net profit, I'll say, yes, it is undoubtedly a JV. If they are getting a share in the assets and liability and revenues and expense, I would say it is a joint operation. So step number 2 is going to override the step number 1. Now watch this carefully, hear this very carefully. You decided by virtue of a legal form that it is a JV. You created a company. I said, okay, you created a company, it's a JV. Then I went to the contractual arrangements. I found out that the parties have decided to give themselves share in revenue and expense, share in assets and liability. I'll say, okay, the contractual terms are telling me that it is a JO. So step number 2 will override the step number 1. I'll say, no, it's not a JV. On the apparent, it was looking at a JV, but it is supposed to be a JO. Then you will indirectly tell me, so if step number 2 is going to override the step number 1, why are you looking at step number 1? If your step number 2 conclusion is going to be overriding the conclusion in step 1, then what's the good need in terms of looking at step number 1? Well, it is not necessary that contractual terms will always be present. Maybe the contractual terms are silent, then what you're getting from a legal form will prevail. It is only if the parties are trying to have manipulative intentions, that on the face of it, they create a company, but they are trying to, override the concepts of the company, and they want to get the share in the asset, liability, revenue, and expense. So I would say, let's me see the contractual terms and then decide. Okay, so moral of the story. In the step number 1, when you look at a legal form, it's like a litmus test. What is apparent on the face of it? You created a company, JV. You created an LLP, it is supposed to be a JV. So on the very apparent front, when you look at the situation and you say, okay, you created a company, it is supposed to be a joint venture. You created an LLP, it is a joint venture. And if you say that it is supposed to be a firm, then I would say, if it is supposed to be a firm, then it is a JO. I'll not stop at that end. I'm going to go to the step number 2 and I'll start digging into the terms of the contractual arrangement. I'll start digging into the terms of the contractual arrangement and see what is the arrangement between the parties. Are they trying to get a share in the net assets and net profit? It is JV. Are they trying to get share in assets, liability, revenue and expense? It's JO. And then step 2 prevails over the step number 1. Decisions on step 2 overrides the step number 1. Now, if you go to the step number 1 and you go to the step number 2, there is no need to look at step 3 technically. Your decisions on legal form and the terms have given you a decision. Now, if the step number 2, the terms are silent, then I might have to see, okay, let me dig it further. Let me find out, how they're running the arrangement. I'll have to see andar ki baat. So which means on the legal form, I find out the contractual terms. They're not documenting any contractual terms. They're not saying that the parties are going to get assets, liability, net assets, or whatever. I say, okay, not a problem. Let me go to the step number 3. So after step 1, you go to 2. If the step 2 is silent, you go to the step number 3. Don't worry, I'll document the notes. When you go to the step number 3, you need to now see how the arrangement is running. And if the arrangement is running in such a way that it is indirectly telling me that it is a JO, I'll say JO, or a JV. I'll have to dig things. What are the things I need to see? I'll explain with an example. I'll explain with an example that what are the facts. But let me also tell you that step 3 is going to prevail over the step number 1. By a legal form, you decide a JOJV, but when I dig the facts and circumstances, I reach a different conclusion. 3 is going to override 1. So you look at step 1 and then 2. If 2 is silent, then 1 and 3. 2 is supersedes 1, 3 supersedes 1. 2 is going to supersede 1, 3 is going to supersede 1. So we are looking at these additional steps to be on a safe side, that on a very apparent level, you do not make a fool and you prove that it's a JVJO. We need to dig in further. Your contractual terms might be manipulating situations. The other facts and circumstances might indicate that things are being manipulated, and therefore we're going to take decisions based on that. Okay, let's do one thing. Let us first of all, I guess, take you to an example, and then we're going to document the steps. So just keep the basic thoughts in mind. That what is the basic thought right now? You need to see that did you create a separate vehicle? No, JO. Did you create a separate vehicle? Yes, 3-step model. Step number 1, look at the legal form and decide JOJV. Step number 2, look at the contractual terms and decide, are they getting share in net assets or net profit or asset, liability, revenue, expense? Decide. 2 prevails over 1. If 2 is silent, go to the step number 3 and dig the facts and circumstances. So I will document the 3-step model once I'm elaborated on the step number 3. Then I'll document the steps to you. I hope my chain is pretty much clear so far. Okay, I guess, Kosh, you said in the case other than tie, no use of the, okay, that was for the previous one, no use of the casting chairman. That's right. But the presence of the casting vote of the chairman itself is indicated that there is a control. Because if people don't agree, you are the person who decides. You've got a control in that case. Okay, let's take you to 2 very interesting examples which are given in the standard itself. So I'm looking at one of the examples which is given in the appendix to the standard. So let's have a look at the example number 4. So this is an example which I've taken from the appendix to the standard. It's given in the study material as well. I think this will give us a better understanding of the 3-step model. Let's, I think, begin the journey. Let's read the inputs to you. It says, assume that 2 parties structure a joint arrangement in an incorporated entity. In an incorporated entity, that means a separate vehicle was created. If a separate vehicle is created, it tells me that I need to apply my 3-step model in this particular case. The moment you know that you've created a separate vehicle for this purpose, we need to consider in this particular case that we need to apply a 3-step model. Let's take it further. It says each party has got a 50% ownership interest in the incorporated entity. The incorporation enables the separation of the entity from its owners, and as a consequence, the assets and liabilities in the entity are the assets and liabilities of the entity. So he is very clear. He said that the incorporated entity is ensuring that there is a separate legal entity which is getting established. In such a case, the assessments of the rights and obligations conferred by the party from the legal form. So if I look at the legal form of the organization, I can say, yes, a separate legal entity is getting established. It is a JV. So the legal form in this case is telling me that it is a joint venture, because a separate legal entity is getting established. Okay, then let's have a look further. So in this particular case, it indicates that the parties have rights to the net assets of the agreement. So which means we have concluded that based on the legal form, that is the step number one, it is supposed to be called as a joint venture. So let's go to the step number two. However, the parties modify the features of the corporation through a contractual arrangement. This is step number two. So the parties, by way of contractual agreement, modify the features so that each gets interest in the assets of the entity. Each is liable for the liabilities of the entity, and that is in a specified proportion. So they entered into a contractual arrangement whereby they decided that the parties will get a net, not a share in the net assets, but they will get a share in the assets in a certain proportion, obligations towards liability in another different proportion. So this means what? That the contractual arrangement indicates it's a JO. Such a contractual modifications can cause the arrangement to be a joint operation. There is no need of going to step number three in this case. So if you look at the inputs in this particular case, we can clearly see that when I applied the step number one and I looked at the legal form, I said the legal form of the entity is telling me that a separate legal entity has been established. So therefore it becomes a joint venture. I said, okay, let me go to my step number two and consider in this particular case, what are the contractual terms? What are the contractual terms between the parties? The parties decided to get a share in the assets and the obligation towards liability in a different proportion. I said this is indicating it's a JO, and the step number two prevails over the step number one. So I will say the final conclusion is that it is supposed to be a joint operation, because step number two tells me that the contractual terms, they are trying to, run this company, the so-called a joint venture, as a, you can say, a firm. So it becomes a joint operation to that extent. That was an application of three-step model only till step number two. Let's take another example where we're going to dig to the step number three. Because if step number two is silent, then we need to see further details. Let's have a look at another example, a bigger one. So let's have a look at another example, a bigger one. Let's see the example number 5. So let's have a look at the example 5. Okay. So let's, I think, read the facts of example 5. Just keep the three-step model in mind: legal form, contractual terms, other facts and circumstances. It says, assume that the two parties structure a joint arrangement in an incorporated entity C. Incorporated entity C means that a separate vehicle is being created. And if a separate vehicle is being created, what you need to do is you need to apply the three-step model in terms of taking a decision whether it is a JO or whether it's a JV. Let's begin the legal form, in which parties have got a 50% ownership interest. The purpose of the arrangement is to manufacture materials required by the parties for their own individual manufacturing process. So basically, they're using this vehicle for the purpose of, you can say, their own manufacturing activities. The arrangement ensures that the parties operate the facility that produces the material to quantity and quality specification. Now it says the legal form. The legal form is indicating my step number 1. It says the legal form through which activities are conducted indicates that the assets and liabilities of C are the assets and liabilities of C, which means the legal form is indicating that it is a joint venture. The assets and liabilities of the entity are not the assets and liabilities of the parties. Therefore, a separate legal entity is getting established. So I would say on the basis of step 1, it is a JV. Then he says the contractual arrangement does not specify that the parties have got rights to assets or obligations for liability, which means he's talking in terms of the step number 2, that the contractual arrangement is silent. And if the contractual arrangement is silent, I'll have to look at more facts and circumstances. I just can't stop at the step number 1. We need to see that if there is anything else which is contradicting the step number 1. So in terms of the step number 2, it says the agreement does not specify anything. Accordingly, the legal form and the terms of the contractual arrangement indicates that it is a joint venture. So right now, step 1 says JV, step 2 is silent. So we can say that yes, it's a JV right now, but we need to go to the step number 3. However, the parties also consider the following aspects, which means now I am moving to the step number 3 and trying to look at the other facts and circumstances as well. Now, this is the crucial step. And the need of going to the step number 3 triggers when the step number 2 is silent. If the step number 2 is silent, you need to go to the step number 3 and then take a call. So let's, I think, read the inputs in terms of the step number 3. Now watch this carefully. This is going to be slightly technical, so just go with the flow. Let me just clear this part. No worry, I will make my 3-step model, document it after the end of this example. We'll do that. Okay, now let's have a look at the other inputs. Now, this is a little technical, but it'll click. It says the parties agreed to purchase all the output produced by C in the ratio of 50-50. C cannot sell any output to third party unless it is approved by the 2 parties of the arrangement. Now let's understand this. They created a separate vehicle and they said that this separate vehicle cannot make a sale to any outsider. 100% output is going to be for the captive consumption of the parties. If I were to apply a logical mind, the output of the entity represents the future economic benefits. Get this very clear, that when you're looking at the output of the incorporated entity, the output of the entity represents the future economic benefits. And this entire future economic benefits is being taken away by the party A and B, no third party sale. If you remember, in terms of Ind AS 12, the word future economic benefit is linked to assets. I said another name of assets is future economic benefits. Do you remember the tax-based definition? And we said that when you look at an asset, the carrying amount of the asset, thy name is future economic benefits. So when you say that the output of the entity represents a future economic benefits, which means the assets. By not allowing the entity to make a third party sale, A and B are going to get the entire share in the assets in a specified proportion, 50:50. So you need to look at the substance of the transaction which is happening. That they entered into the arrangement where they said that this entity cannot sell anything to third parties, so nobody else can get the economic benefits out of it. The entire output of the entity is going to be consumed by A and B in a certain ratio, which means they are getting indirectly a share in the assets. The share in the economic benefits is like a share in the assets of the entity. So this is one. Next. It says the price of the output sold is set by both the parties at a level that is designed to cover the cost of the production and administrative expenses. On the basis of this, the arrangement is intended to operate at a break-even level. Aha. So they have fixed the prices in such a way that it results in a break-even point for the incorporated entity. The entity is dependent upon the cash flows coming from A and B. The liabilities of the liabilities of the incorporated entity is being borne by the money which the parties will give them, because they don't have any external source. They don't get any profit margins. They're totally dependent upon that they get the money to meet the expense and the break even. So all the expenses and liabilities are indirectly being borne. When there is a break even point, it means that all the liabilities, the obligations and the expenses are borne by these parties, again in a certain specified ratio. So by indicating that there is going to be no output, no third party sale, one, the economic benefits, the assets goes to A and B. By also ensuring that the fixation of the prices is done in such a way that it leads to a break-even point, it leads to the dependency of the entity on the parties. The parties are bearing the liabilities and all. So the parties are getting a share in the assets on one hand. The parties are getting an obligations to bear liabilities on one hand in a certain specified portion. So which means that they're running this joint venture so-called on a legal form as a JO. So in this particular case, it says from the pattern, the following facts and circumstances. I'm just going to take you to a conclusion and see what it says out here. Let's have a look out here. It says these facts and circumstances indicate the arrangement is a joint operation because they're running it on the basis of a JO. The conclusion in these circumstances would not change if instead of the parties using their share themselves, they sold it to outsiders. It says the answer doesn't change. If A and B are going to buy the output for captive consumption, doesn't make a difference. They're going to buy it and then resell it to a third party, the analysis doesn't change. The only thing is that the incorporated entity is not allowed a third party sale. The parties take the output for their own captive consumption, it's a JO. The parties take it for their own captive consumption and then resell it to a third party, it still remains a JO. So what is important is that it is not allowed a third party sale, and the price fixation is done in such a way that, they are totally dependent upon the parties to meet their obligations as well as the expense. So I think the facts and circumstances is telling me that it's being run like a joint operation. So I think the step number 2 and 3 is also now taken care. Now we can document the 3-step model in terms of identifying the arrangement. I hope, friends, I am pretty clear on the picture. Okay, so let's, I think, take it further. Let's now document this 3-step model to you. So let me just document this 3-step model which I've created out here. So let me just take it and create a notes on the 2nd step. Then there is an accounting which is pretty simple and straight. So let's begin the journey. Let's, I think, document the main issues on step number 2. We're deciding on the type of the joint arrangement, which is a part of my step number 2. And I'm going to create again a 3-step model on this. Step 1, I've already given you a 3-step model that it is CA, then it is supposed to be a CC and a UC, 3 steps. And this is again a 3-step model on the types. So let's create a 3-step model. So before the 3-step model, there is a small question which you need to put across, or rather, let's do one thing. Let's first put a question and then go to the 3-step model. So first you put across a question. Did we create a separate vehicle? So we're going to first of all put across a question that did we create a separate vehicle or not? Did we establish a separate vehicle or not? That is the key question. So if I say yes, we created a separate vehicle, you need to go to the 3-step model. You need to go to the 3-step model. And if you say, no, we did not create any separate vehicle, you've decided it is a joint operation, simple and straight. Then we come to the 3-step model in this case. Then we come to the three-step model in this case, and in terms of the step number one, we first put across a question that what is the legal form? So we need to see what is the legal form of separate vehicles. So whatever separate vehicle you've created a company or LLP or whatever. So we need to see what is the legal form of the separate vehicle. So there are three permutation combinations which could arise. So you could say that we've created a company, or we've created an LLP, or we've created a firm. So if you say it's a company or an LLP, the conclusion is it's a JV. And if you say it's a firm, the conclusion is it's a joint operation. So basically what we are checking in terms of the legal form is that are we looking at a separate legal entity is getting established or not? So when you're looking at the legal form, we're looking at is the separate legal entity there or not? So in this case, a separate legal entity is there. In this case, it is not there. Irrespective, we go to step number two. So whatever conclusions you've drawn on this basis, irrespective, we're going to go to the step number two. So your step number one decides anything, JO, JV, whatever, we're going to go to the step number two, irrespective. Okay, so this is step number one. Let's go to the step number two. Then in terms of the step number two, what do we need to do? We need to see the contractual terms. Let's circle the box, create a box, contractual term. See the contractual terms of the parties. So we need to see that what are the contractual terms of the parties. What is they getting? Are they getting share in net assets or net profits? So there will be two possibilities. So the parties might be getting a share in net assets or net profits, or the parties might be getting a share in the assets and liabilities and revenues and expense. So they may be getting share in assets and liability, or they may be getting share in the revenue and expense. So if this is the case, it indicates that it is a joint venture. If this is the case, it indicates that it is a joint operation. And then we can say decision of step two overrides the step number one. So whatever you decide as per step two, that's going to prevail. So if you decide JV, it's a JV. If you decide JO, it's a JO, whatever you might have decided in terms of step number one. And then we go to the step number three. But we go to the step number three only if step two is silent. Only if the step two is silent. So if you see that there is no data, the step number two is silent, the parties have not entered into any contractual terms regarding the assets, liability, revenue, expense, then you go to the step number three. And in terms of the step number three, you need to dig the facts and circumstances. You need to dig the facts and circumstances in this particular case. You need to look at the additional facts and circumstances. And I guess, let me put it here again, the decision of step three overrides step one. So the decision in terms of step three overrides the decision what you've taken in step one. So two is overriding one and three is overriding one again. And we go to three only if the data on step two is silent. Now, in terms of firm's circumstances, we can say that there are two parameters to be called as a JO. So you need to see the parameter number one. that there is no third party sale. So you need to see that there is no third party sale, and which means the entire output is indirectly going to the parties itself. And you can say the price is fixed in such a way, the prices are fixed in such a way that it results in break-even point. That it results in a break-even point. So if you see these conditions, that there is no third-party sale and the fixation of the prices is resulting in a break-even point, then we can say in this particular case, if these conditions are met, it would indicate that it is a joint operation. And if these conditions fail, then it would indicate it's a joint venture. So this makes it a three-step model in terms of deciding that the arrangement is a JO or the arrangement is a JV. Right, friends, I guess I would have made myself pretty clear. I guess the second step is also pretty clear. I guess your comfort zone should be quite good. So out of the total three-step model, I have covered the aspect of number one. Is it a joint arrangement? 3 steps. Then step number 2 is a JV or JO, again a 3-step. I guess that should be pretty much clear and you should be pretty much confident so far. Okay, now comes the last chain in this case. Okay, I think Kaushik, you said share in the net assets or asset liability thing, do it really have any impact? Yes, you see, if you're having a share in the net assets, it could be, 60% net assets. But if you say asset and liability, it could be 60% asset, but let's say 30% liability. I create an arrangement where I create a different proportionate share. A share in the asset is larger, the share in liability is smaller. We may not have an equal state. Otherwise, yes, it is the same. So it's like, deciding a different percentage for the asset, different percentage liability, different percentage revenue, and a different percentage for expense. Okay, now friends, I'm going to give you the step number 3. And as I promised you that I'm going to give you some very interesting chart on the step number 3, in which case I'm going to give you a lot of permutation combinations and you'll be able to understand that in which cases what will trigger. This is a very authentic chart I have developed on the basis of my own research, and this will capture all the things in a single chart. You'll love this particular chart because it's going to give you everything in a single chart itself. So let's start creating a chart. And I am working in terms of my step number 3, that is accounting. I'm working now in terms of how the accounting will take place. Now let's get one thing very clear. There are various permutation combinations coming to my mind. Let's get the chain first of all. Let's create a chain, and with the help of which I'm going to work upon the accounting. I am first of all looking at 2 broader areas. If it is supposed to be a joint operation, I would say books of the joint operator. If I say joint venture, I would say the books of the venturers. The standard gives you the accounting in the books of the parties and not in the books of the JV or the books of the joint operation. So here the accounting is in the books of the parties. So when you're looking in terms of the accounting, we're looking at the accounting in the books of the parties. We're looking at accounting in the books of the party. So if it is a joint operation, we're looking at the books of operators, joint operators. And if it is a case of a joint venture, I'm looking at the books of the venturers. I'm looking at the books of the venturers. So you need to be clear that if it is a JO, the focus is the books of the joint operators. And if it is a JV, the focus is the books of the venture. That's one. Next. If you remember the example where I said A, B, C had 50, 30, 20. You would recall that I said that A and B in this particular case have got a, 50 plus 30, they've got a joint control, but C doesn't get a joint control. So if you recall, I gave an example where A, B, C had 50, 30, 20. So I said, okay, A and B have got a joint control, but C is not a party to the joint control. So there can be two kinds of parties, I would say. So I would say there will be two kinds of parties which can be there. So we will divide this in two sections, because there can be a party which has got a joint control, or there may be a party which does not get a joint control. So we can have a combination that the parties have a joint control. Or we can say there is a particular party or parties which has no joint control. He is a party to the arrangement without a joint control. Like A and B were having a joint control, but C, I said you go to Index 28. Similarly here, you could have parties who may have a joint control, or there may be a party or parties who have no joint control in this particular case. So there are basically, you can say, a total of two combinations which are working. So we can say that in the books of joint operator, these are the two kinds of party. And in case of a joint venture also, these are the two kinds of party. Now, a further input. I'm looking at the accounting treatment in both the set of books, and I'm looking at the accounting treatment in separate and consolidated financials. I'm looking at the accounting treatment in the books of the parties when they are going to make a separate financial statements and when they are going to make a consolidated financial statements. So if you're able to fill up this chart and get the permutation combinations of 8 areas of accounting, I am done. Brilliant. I've taken all the permutation combinations, the books of the joint operator with a joint control or not, separate and consolidation, and the same combinations works out here. So let's now begin the journey, and let's give you the answers in each and every permutation combination, which particular standard would trigger. Let's get this. Okay, so let's begin the journey now, friends, on here. If you're looking at the books of the joint operator, irrespective of any of these permutation combinations, common accounting treatment. Common accounting treatment. You say separate financial statements of the joint operator. You say consolidated financial statements of the joint operator. You say, I am a party with a joint control. You say, I'm not a party with a joint control. This standard does not make a distinction in terms of the accounting treatment. What do you need to do? You need to add to your assets and liability the share in assets. You need to add the share in liability. So in the balance sheet, in your balance sheet, in separate financials, you take your asset plus the share of asset. In the balance sheet, you take your liability and the share in the liability. Similarly, in the income statement, you're going to consider the share in the revenues and you're going to take the share in the expenses. So whether it is a separate or a consolidated financial statements, what do you need to do? You take your assets and liability, add the share in the asset, share in the liability. You take in the income statement your income and expense, the share in the income, the share in the expense. So indirectly, sometimes people call this as a proportionate consolidation, but I would say it's not exactly a proportionate consolidation because it may not be an equal percentage stake in the assets, liability, revenue, and expense. So I would prefer to call it as that you need to add the share. So when you make your income statement, insert the share in the revenues of the JO. Insert the share in expense in the JO. When you make a balance sheet, just add the shares in the assets. There is a small little example which is given in the study material, which also tells you that, okay, if they've given a balance sheet and you just need to identify, okay, this percentage is going to be added to the assets, this percentage added to the liabilities, whatever. The criticality comes on this front. Then when you're looking at a separate and a consolidated financial statements, then which kind of standards would going to be triggered out here? So let's have a look. Now let's have a look out here in this case. If you're looking at a separate financial statements and the parties have a joint control, you are supposed to apply Ind AS 27. Since you've got a related party relationship, we're looking at the books of the parties. Who is a party? The party is the investor. The party is supposed to be the investor. So separate financials, he would apply Ind AS 27, and consolidated financials, he would apply Ind AS 28. Where we're going to learn in the next class that there is a method of consolidation which is called equity method. We've got a bit exposures earlier as well, but we're going to exclusively see what is the concept of equity method. So a party which has got a joint control uses Ind AS 27 for separate financials where the investment will be taken at cost or it will be taken at a fair value choice. Ind AS 27 says that when you make a separate financial statements, you need to take this investment at a cost or a fair value. When you say that you're going to take a fair value, this fair value takes you back to Ind AS 109. So generally in a practical life situations, companies would prefer to take the investments at a cost itself. So you take the investments at cost or a fair value, the choice is available. But if you choose a fair value, then Ind AS 109 applies. Okay, now let's come to the status that the party has got no joint control. Remember the example of ABC where I said that C does not have a joint control. Go to Ind AS 28. So I would say, okay, you assess, does the party have a significant influence or not? So make an assessment that maybe, okay, he doesn't have a joint control, it's okay, but make an assessment that does he have a significant influence? If you say yes, he's got a significant influence, you can apply Ind AS 27. If you say no, he's not got a significant influence, then you got to apply Ind AS 109. Then you would apply Ind AS 109. So a party which is not having a joint control, you need to go and see maybe he's got a significant influence. If he's got a significant influence, you go to 27, same inputs. And if it is not a case of even a significant influence, then it is a passive investment, 109 would apply. Okay, then let's come to this case, consolidated financials. Here again, you need to do the same assessment. Does the party, you need to see, does the party have a significant influence or not? So here again, you go to see that does he have a significant influence or not? He doesn't have a joint control, but maybe he's got a significant influence in this particular case. So the answer could again be a yes, or the answer could be a no. If the answer is a yes, you're back online, then I'm going to use Ind AS 28 because Ind AS 28 applies in both the cases, whether it is a joint venture or whether it is an associate relationship. So in this particular case, again, Ind AS 28 would apply. And if you say no, there is no significant influence, then consolidated financial statements not applicable because you're now a passive investor. And in terms of passive investor, the concept of consolidated financials would not apply. So you can see now the summary in terms of things, that what is the accounting treatment in terms of the step number 3. If it is the books of the joint operator, it's a common treatment irrespective of any permutation combination. If it is a case of a joint venture, then if you've got a joint control, 27 for separate, 28 for consolidation. If you don't have a joint control, you need to see if there is a significant influence, the status is same. If there is no significant influence, then you're a passive investor, then it is 109. So this is the third step, the chart. Now my Ind AS 111 conceptually is done. I have given you all the 3 steps which we covered. We've covered the concept of whether it is a joint arrangement or not. I gave you 3 steps. Joint arrangement means CA, CC, UC. Then I gave you the types of arrangement. Did we have a separate vehicle? No, JO. Yes, go to the 3-step. Legal form, contractual terms, or the facts and circumstances. And then we went to the step number 3. Once you've zeroed down what is the accounting in the books of the parties, the investor, in the separate, in the consolidated financials, depending you've got a joint control or not. I guess you will got a complete picture on this particular standard. So tomorrow, in any case, there's no class because we preponed the tomorrow's class today. And I guess Thursday, there is no class again. I think it's festival day, Eid. We'll be meeting, I guess, on Saturday. So that would be where we're going to cover Indus 28 with you friends on that day. So let me see if there are any questions coming at your mind. I guess a lot of inputs given today. I guess you've got a lot of knowledge today. But what do you need to do now? You need to keep doing your consolidated revisions on things, revise everything put together, practice the questions from the study material and all. And trust me, with these inputs and all, I feel you're going to be much, much more confident in terms of things. Okay, I guess there seems to be no further questions coming in, I guess. So I think it's time to bid you goodbye, friends. On that, I'm going to see you on Saturday. And enjoy the days. I think 3-4 days you may not have these classes for effort, but other classes are there. So do take out time for your revisions as well. So time to bid you goodbye, friends, on that. See you later. Thank you. Bye-bye and take care.